So let's start with our first topic, that is SLM. That is SLM, security market line. Actually, what is security market line? The first question. Security means all the instruments, whether share, whether preference share, whether debenture, bond, GSEC, government securities, any hybrid security, option, future, all are a comprehensive term security. This is so there is a very famous formula, that is a cap M. Generally in the books they are pronounced at CAPM formula, but as per approach, professional approach, that is called CAP-M formula. CAP-M formula. So the full form is a capital assets pricing model, and yes, no doubt, you can mention this formula as a indicator, or one very nice terminology is used. The terminology is GPS for the investor. GPS, do you know? GPS is a global positioning system, where you are at this time. Right, Mr. X, you are in Delhi. Please send your GPS location. This is a type of confirmation of the position, geographical position. So as per concern of the stock market, the position can be indicated. Can be is not a good term. That is a maybe indicated by the CAPM model. So very famous CAPM, and many years this formula is used. But as per concern of the Indian security market, there is a less vitality. There is a less. I want to conformity whether it is a very vital for the Indian security market. Then my opinion is not too much viable, not too much valuable, with a very slow tone. So in the continuation of the topic, we can say CAPM is a base of SML, security market line. What the security market line says to us? Security market line, this is a 0. 0 is this is a 0.0, and this is a x-axis, you know very well, and x-axis is you can say beta. X-axis you can say beta, but beta is a systematic risk. Beta is a systematic risk, unsystematic risk you cannot control. So we want to discuss the graph. So in this graph, there is a chart of, there is a y-axis, and y-axis represents the return, or we can say expected return. So it is clear that return of the government security is called RF. This represents RF, and this is a return of the market, and return of the market represents as a RM. M indicates in a small form. Then you know what this gap is called? This gap is called market. This gap is called market premium. This gap is called market premium. market premium is called. है ना? Market premium is what? Market premium is RM minus RF. RM minus RF. Okay. So where this line cuts the systematic risk by the RM, है ना? This is the position of the M, and from these line which start from the risk-free security, SML line will draw from the risk-free security. From the risk-free security, this straight line is drawn, and it is very easy. All the securities whose return is more than above than this SML line, that securities is basically undervalued security, and other securities are overvalued. So what is recommended to as an investor? Always buy to the undervalued security. It is better for us. Always buy to the undervalued security. It is better for us. है ना? So this is the interpretation of the security market line graph. Now let's take an example. Imagine you are eyeing a Tata Motors. It means you are watching the share of the Tata Motors, which holds the beta of 1.8. 1.8 beta means this security, that is Tata Motors, is 80% higher risk than market risk. It means generally which beta is indicate as a market beta, that is 1. You can say in a different term, market beta is always 1. If the beta of the Tata Motors is 1.8, it means in compared to the market, the risk of this security is 80% high. So one thing is also mentioned here, 10-year government bond, that is risk free. Government bond is always risk free, it is considered. But one thing is you have to know that nothing is risk free. Risk is always there. But up to some extent, we can say that the government bond is guaranteed by the government, central government or state government, or both maybe. So the public of investor of Indian country, they consider as a government bond basically risk free. So 7% is giving just government is giving just 7%, and Nifty return represents the RM, return of the market, that is 12%. The Tata Motors expect return. Just use the CAPM formula. CAPM formula is equal to RF plus beta RM minus RF. This is the formula, and put the value. RF is 7%, है ना? Plus beta is equal to 1.8 is given in the question now. Yes, sir. Multiplied by the market premium, and you know the market premium, that is RM minus RF. You can say 12% minus 7%. So write this 7% plus 9%. You know why 9%? 5 multiplied by 1.8 is equal to 9%. So total expected return of the security Tata Motors is 16%. If Tata Motors is giving more than 16%, then we can say that Tata Motors is undervalued. If Tata Motors provide less than 16%, we can say that Tata Motors is giving less return. That's why we can say that Tata Motors is overvalued. So we don't recommend to buy the overvalued shares. Okay, now what about next? The next is a APT. APT is a arbitrage pricing theory. Arbitrage pricing theory. What is arbitrage pricing theory? Arbitrage pricing theory recommended to us. It is just arbitraging pricing theory is considered as this is the extension of the CAPM formula. This is the extension of the CAPM formula. So let's read out what the given in the slide, and we will explain each and all the specific term. So while CAPM is used, one factor is a market factor. One factor is a market factor. Hey, so the multiple factor return can be calculated. Think just like a GDP. Market factor is a one factor, GDP is another factor, and so many factors may be considered that as it is. So arbitraging is basically what? Arbitraging is basically exploitation of the price difference of the two different marketplaces. So the formula of the APT advises to us, expected return will be, this is the advancement of the CAPM, just please think about. So beta of the one factor, same as CAPM formula, but we use the different type of beta in the same CAPM formula. So first factor beta, second factor beta, and so on. And we can use the factor based beta to the market premium. Just watch a single example and you will easily understand what the APT tells to us. Okay, so there is a suppose system says that the Reliance industry, the first factor is discussed, that is crude oil prices. Crude oil prices is the first factor as per APT theory we are considering. So market premium is 4%. You know the market premium, sir, very easy. RM minus RF. Is market premium. That is 4% is given. So second factor is given Forex. Forex is the Indian INR and USD exchange. So that beta is 0.8. This is a less risky segment. And the premium is just 3%. So what will be the expected return? Expected return is a risk-free. And where this 7% came, this 7% is considered from the previous question. Risk-free, that is 7%. Beta is, crude oil is 1.5 and premium is 4. Ab yahan par then different, that plus beta is 0.8, premium is 3. Then how much the return, expected return? Sir, risk-free plus 6%. You know the 6%? How came? Sir, 1.5 beta multiplied by 4. Okay.